All right, so let's look at our chapter. We got some questions here that deal with job order costing for managerial accounting. And we're just going to run through here. This is a lot of what we call objective type questions. Not much in the way of calculations going on right here, but this will certainly help, hopefully strengthen your understanding of some of the basic concepts related to job order costing. So it looks like we're going to start off with a true-false question, and it says the key feature of job order costing is that the cost of one job differs from that of another job and must be kept track of separately. And what they're trying to basically say here is, okay, does this kind of definition here, does that fit job order costing, or does it fit what we would call process costing? And this is most definitely a job order costing technique that we would use. We're going to keep track of each job. That's kind of a key word here, individually, so that we can make sure we can determine whether or not we're making any money on it. In process costing, which your chapter talks about, I don't care what your book is, it'll talk about it. With process costing, everything, we're making homogeneous products or products that are the same. So this is a true statement. Which of the following businesses uses a process costing system? So we've got 5 of these listed here, looks like. And so, you know, the point of the name of the chapter is job order costing. That's what we're looking at. But we do need to be able to distinguish types of businesses that would use a process costing system and a job order costing system. We know whenever we get to the next chapter, which is process costing, we'll probably have kind of the reverse image of this question. So ask yourself this question: are all products the same or not? And if they are, then we have a process costing system or a business that uses them. So a printing business, this is not going to use process costing. We might want to make some campaign signs. We might want to make 5,000. We might want to make 1,000. We might want them to have 4 different colors, 2 different colors. Each job is different. So this is going to be job order costing. A dental clinic, let's face it, some people's teeth are more messed up than the next person's. So the dentist has to charge accordingly. This is, again, job order costing. An interior design firm. This is largely going to be based upon square footage, the number of options you want the design firm to present to the customer. In other words, one size does not fit all. This is also job order costing. An automobile service center, a mechanic basically. Again, you know, somebody that has a little crack in their windshield or something minor is not going to be charged the same as someone who needs an engine overhaul. So this is job order costing. A refinery is a business that processes oil. Well, we want all of that oil to be the same. We don't want there to be any difference from 1 barrel to 1 gallon to 1 quart. So a refinery would use a process costing system. A normal job order costing system is a system that uses, so what we're referencing here is, you know, we have what we call normal costing, which is what I will teach you, and then versus actual costing, which I will teach you just enough so that you can distinguish between the 2 types. Okay, but normal costing is the far superior method, and that's what we're talking about here. So let's see here. It says actual cost for direct materials and estimated costs for direct labor and overhead. Estimated costs for direct materials, direct labor, and overhead. Actual costs for direct materials and direct labor, and estimated costs for overhead. And then actual costs for direct materials and overhead, and estimated costs for direct labor. So actually, none of these examples here, A through D, describe actual costing. In actual costing, we use actual cost for all three components. And we say that with normal costing, we're going to use actual direct materials, which is the same as actual costing. We're going to use actual direct labor, which is also the same as actual costing, but we're going to estimate overhead. Okay? So if we look here at choice C, it says actual costs for direct materials and direct labor, and then estimated costs for overhead. That is normal costing. Let's see if we can get this straightened away here. It says, what is an advantage of normal costing over actual costing? So right on cue. Choice A says the overhead allocation rate is always less. Well, there is no overhead allocation in actual costing because we're using actual overhead costs. There is no allocation of overhead, at least not in the sense that they mean. So that's not going to be right. B, product costs won't vary as much from month to month. That sounds pretty good. Let's see what else they have. The labor hours worked is always less. Well, there's no way that a costing technique can dictate how many labor hours we're going to have. And product costs will reflect the amounts of overhead used. Well, no, product costs in actual costing we would do this, but that's a problem due to the cyclical and seasonal nature of a lot of businesses. So, with actual costing, as we've mentioned in some of the PowerPoint videos, the issue with actual costing is, you don't have to do any kind of reconciliation at the end of the period, but our fixed costs are a real problem. They'll cause us to underreport our costs in periods of low production. Let's see. Now, what did I say? I think I said that backwards. Whenever we have low production, and we use actual costing, fixed costs are a higher proportion of total costs, and so our products tend to be overpriced. And then whenever we have periods of high production, our fixed costs are a lower percentage of total costs, and we end up having products that are underpriced. And that's not good either. All right? So we can kind of smooth our costs out a little bit better, or a lot better, with normal costing. What are the 3 steps of overhead application? Step 1 is to determine predetermined overhead rate or rates. Okay? That is the first step. And this says OH right here. Overhead. So determine predetermined overhead rate, as in a single plant-wide rate, or rates if we are using departmental rates that have with different cost drivers. Number 2, apply overhead during the period. And 3, reconcile differences between actual and applied overhead. This is that part where usually if the difference between actual and applied overhead is not material, we're just going to, under applied overhead is going to be added to cost of goods sold, and over applied underhead is going to be subtracted from cost of goods sold, and then we have a different process for that whenever the difference between these two is material. We have to allocate that difference evenly between cost of goods sold, work in process, and finished goods. All right, let's look at a couple more questions. This video is starting to get a little bit long. Which of the following mathematical equations is used to calculate a predetermined overhead rate? So the predetermined overhead rate equals, so all of our choices look like start off with the same thing, which is good because that's what we're trying to determine. Choice A says estimated annual manufacturing cost divided by estimated quarterly activity level. Well, I will just tell you that this is wrong on both ends. Actual annual cost of goods sold divided by estimated semi-annual labor hours. That is, again, wrong in both ways. Choice C, estimated annual overhead divided by actual annual activity level. Well, we've got it half right. Choice D, actual and actual. These are always estimates. Looks like choice C is probably going to be our winner. Predetermined overhead rate equals estimated annual overhead divided by estimated annual activity level, i.e. cost driver. Okay? So we may say that if we were to say that we estimated overhead to be $600,000, it would be $600,000. And then let's say that our cost driver was direct labor hours, and we estimated that we were going to have 100,000 hours. This would be our formula. And our predetermined overhead rate would end up being $6 per direct labor hour. Okay, I made all of this up here, the 600 and the 100,000. Okay, all right, let's see here. True or false, actual overhead is reconciled with applied overhead at the beginning of the period. So I made the statement true, but the way it was originally written with beginning, this is a false statement. Okay, let's see here if we want to keep going or not. And I want to, I think what we're going to do is we're going to go ahead and wrap this video up, and we're going to come back with another one and look at some more questions after this.